morning, Hema, and good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, I'm not really an expert in terms of socializing and the clubbing and entertainment scene, but we know a bit or two about the financial markets. And today we're talking about the insurance companies. One formerly listed company, Sagicor Financial Corporation Limited, or Sagicor Financial Company Limited now, and Guardian Holdings Limited, for their first quarter results ended in March of 2020. So let me just get this screen up on be able to share the screen. All right, and for the first quarter, we're looking at Sagicor firstly. For that first quarter ended 2020, the group recorded fully diluted earnings per share loss per share actually of 20 cents US dollars, as compared to that a gain of 22 cents in the prior comparable period. Now, yes, it does make for not very good reading. Total revenues were down from 516 odd million to 343 million. Total benefits and expenses also declined just around 26% from 478 to 355 million. And overall, income attributable or net income attributable to shareholders fell from 15.6 million for the quarter in 2019 to a loss of 29.3 in the first quarter of 2020. Now, it may alarm investors at the very surface of it, but however, much of it could be explained due to swings, or very wild swings actually, in financial markets. And these were all predominantly unrealized losses, which would have taken place or occurred because of that very sharp decline in equity markets and bond markets, which was experienced in the first quarter of 2020. Perhaps around March 11th to March 13th was where the market effectively would have bottomed out, being at its lowest levels for the year. And since then, it has recovered quite nicely. Now, when we take a look at Sagicor's profit before tax by operational segment, we could see that performance being reflected largely on a quarter-by-quarter basis. Sagicor Life USA swung from a profit of just about 9 million US to a loss of 18 million US. Sagicor Life would have declined from 14 million to just around 4 million. Sagicor Jamaica declined from 35 to 22 million, so barely holding its own. And head office and other expenses deteriorated from 13 million to 26 million overall. Now, the acquisition activity of Sagicor was one of the strongest selling points for investors in greenlighting this deal to take Sagicor off of the Caribbean exchanges and move onto the Toronto Stock Exchange. Now, since then, much has changed in terms of the acquisition landscape. The British American and Colonial Life portfolios would not have been part of the initial deal that would have been touted to investors, but those have since been announced and are pending regulatory approvals, but they seem to be, it's just a matter of when and not if. Scotiabank, Insurance Trinidad and Tobago, Sagicor was supposed to take over or acquire that particular business line from Scotiabank. The deadline for that deal is tomorrow, actually, or the expiry date, and with no notice of any acquisition taking place from Sagicor, it is very likely that deal will not go through, which follows closely with the announcement that the Scotia Jamaica insurance franchise, which was also supposed to be acquired by Sagicor, is not going to go through. Now, that puts Sagicor in a very healthy cash position with about 400 million US in cash on its balance sheet and nowhere to really invest it at this particular point in time. And two particular initiatives have come up since then. Sagicor has announced a share buyback given the precipitous decline in its share price. Now, investors in Sagicor would have noted that the exchange price for Sagicor was, when the deal was announced, was 10 Canadian dollars. And that has fallen very quickly to $5.33 Canadian. So a very sharp, almost 50% decline in the price of Sagicor. Now, at this particular price, the stock is trading at a PE multiple of 6.8 times, which relative to its Canadian comparables is fairly attractive. And the dividend yield is pretty much spot in line with its Canadian peers at around 5.9%. So Sagicor would have announced a share buyback where they're going to buy up to 2% in the initial instance of the existing outstanding shares, which at a cost, or estimated cost of just around $12 million US. So it seems that the company is going to put some of its excess capital, or excess cash rather, to use by creating some liquidity for shareholders who seem to be wanting that particular liquidity. So at its current price, Sagicor we would see be at relatively fair valuations. Some uncertainty driven up because of that lack of acquisition activity or some of those mooted acquisitions not materializing, and as well as that economic uncertainty. All of those factors would contribute to rating Sagicor or leaving the rating of Sagicor at a neutral. Turning quickly to Guardian Holdings for its first quarter. Guardian Holdings also swung from a profit loss from 49 cents in the first quarter of 2019 to a loss of 16 cents in the first quarter of 2020. The major change, of course, would have been that net income from investing activities, which would have fallen from 301.8 million to just around 26.7 million. So a more than 90% decline there in net income from investing activities. Overall net income from all activities would have fallen by around 50% from 486 million to 247 million. And that loss attributable to equity holders, or profit attributable to equity holders, would have been 36 million versus that 112 million in the prior comparable period. Now, in terms of the net income by revenue streams, we can see that in that orange column, net income from investing activities has been a very significant contributor historically to Guardian's overall net income streams, and that would have been significantly impacted in similar fashion to Sagicor by what would have taken place in financial markets in the first quarter. Now, the very good news is that financial markets, by and large, especially in international markets, have bounced back to quite a large extent. So we should see, in the case of both Sagicor and Guardian, for the second quarter at the very least, some recovery or significant recovery in those valuations materializing in above average. We expect above average performance for the second quarter. So at the price of $18.90, Guardian is trading at a PE multiple of 8.1 times, which compares quite favorably to the average of the sector, 15.6 times, and does still offer a quite juicy dividend yield of 4% compared to the sector average of 2.3%. Notwithstanding, the COVID-19 impact is still quite in its early days and is expected to be prolonged a bit as we see the second wave rising in the US, and that could have ramifications for how quickly our own economy reopens in terms of the borders reopening, etc. And that leaves quite an uncertain element in all stocks, including Guardian. And on that basis, we are maintaining our neutral rating on Guardian. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, as well as check out our website where all of our research is absolutely free at bourseinvestment.com. That's it for this week's edition. This has been the Bourse Report. Have yourself a wonderful week. Back to you, Hema.